The letter arrives looking routine. New account confirmation. Zero balance. Small print. A customer scans it confused, then shrugs and tosses it aside. Weeks later comes a fee notice. Then another letter, a credit card this time. The customer did not apply, did not sign, did not agree. Inside bank branches, the pressure is already crushing. Daily quotas, hourly check-ins, miss the number and your job is on the line. Managers push, emails stack up. Coaching turns into warnings, warnings turn into write-ups. The message is clear, sell or disappear. So some employees choose survival, they move money without asking, they open accounts without permission, they invent emails and personal identification numbers. Not once, but again and again, customers feel it last. Damaged credit, fees they cannot explain, trust slipping away quietly. By the time regulators step in, the damage is already wide. What looks like fraud begins to look like a system doing exactly what it was built to do. Chapter 1. Sales targets turn toxic. At the center of the American retail banking system sat a company that promised simplicity and trust, branches on every corner, friendly tellers, a brand built on stability. Inside Wells Fargo, a very different reality took shape behind the counters. By the early 2000s, retail banking had shifted from service to sales. Executives pushed a strategy known internally as cross-selling. The idea was simple. Each customer already had a checking account. Why not add savings, credit cards, overdraft protection, online banking? The more products per customer, the stronger the relationship. That metric became a number that mattered more than anything else. Branch employees were measured daily, not monthly, not quarterly, every single day. A teller who helped customers open accounts was no longer judged on accuracy or courtesy. They were judged on how many products they sold before closing time. Missed the target too often and consequences followed. Managers held morning huddles where numbers were posted and read aloud. Names were attached to shortfalls. Employees were asked to explain themselves in front of coworkers. Afternoon check-ins followed. Emails arrived reminding staff that performance was slipping. Coaching sessions turned into written warnings. Warnings turned into termination paperwork. Former employees later described the pressure as constant and suffocating. Sick days did not pause the quota. Vacations did not reduce expectations. A slow day meant failure, not understanding. A customer who said no was treated as a lost opportunity that counted against the employee, not the system. Internal documents later showed that many workers believed missing targets would cost them their jobs. This belief was not abstract. Employees saw colleagues dismissed for low sales numbers even when customer service scores were strong. The lesson spread fast. Protect the numbers or prepare to leave. At first, rule bending seemed small. An account opened with verbal consent but without full disclosure. A product added with rushed explanations. Some employees convinced themselves they were helping customers by setting up accounts that could be closed later. The line between persuasion and deception began to blur. Then the pressure increased again. Branch managers were also under the gun. Their bonuses depended on branch performance. Regional leaders demanded improvement. Emails from above framed low numbers as failures of leadership. Managers passed the stress downward. Staff meetings became confrontations. Employees were told to be creative, to find a way. Creativity took a darker turn. Some workers began opening accounts without customer permission, a savings account with no funds, a credit card application that would never be used, a debit card mailed to a customer who never asked for it. Fake email addresses were created to complete enrollment. Personal identification numbers were set without consent so accounts could be activated. These actions did not happen once. They repeated in branch after branch and state after state over years. Internal whistleblowers tried to raise alarms. Some contacted ethics hotlines. Others reported concerns to supervisors. In multiple cases, employees said they were ignored or told the problem was limited to a few bad actors. Complaints were documented, then buried. When employees refused to participate, consequences followed. Some were demoted, others were fired. Termination records often cited performance issues rather than misconduct. Those who played along survived. Those who resisted disappeared. Corporate leadership maintained that the sales model was sound. Public statements emphasized accountability and ethics. When early reports of misconduct surfaced internally, the response focused on discipline at the branch level. Individual employees were blamed. The system was not questioned. Executives framed the issue as isolated wrongdoing, a handful of dishonest workers, a failure of compliance. Corrective action would be taken, training would be reinforced, the sales goals would remain. What was missing from those assurances was acknowledgement of the incentives driving behavior. Employees later said the rules on paper mattered less than the numbers on the board. Compliance training warned against misconduct in theory. Daily quotas punished anyone who followed the rules in practice. The culture inside branches hardened. Fear replaced trust. Coworkers stopped sharing concerns. Everyone watched their own numbers. Survival became personal. Ethical lines shifted quietly as people adjusted to what the job demanded. By the time senior leaders received aggregated reports showing unusual account activity, the pattern was already entrenched. Internal audits flagged issues. Investigations opened and closed. Findings were compartmentalized. The broader question was never fully confronted. Was it possible to demand relentless sales growth without encouraging abuse? Inside the branches, employees already knew the answer. They saw it in the way managers tracked hourly progress, in the way missed goals were treated as moral failures, in the way ethics complaints went nowhere. The system rewarded results, not methods. Customers remained unaware. Most accounts sat empty. Fees were small at first, a few dollars here. A notice sent to an address that went unopened. The harm was quiet and delayed. That silence allowed the practice to continue. From the outside, the bank appeared healthy. Profits climbed, investor confidence remained strong. The cross-sell numbers were celebrated as proof of innovation. Internally, the cost was mounting. By the end of the decade, thousands of unauthorized accounts had already been created. The scale was invisible to the public, but impossible to ignore for those inside. Employees joked darkly about ghost account. Managers looked the other way. Corporate leadership insisted controls were working. The first destabilizing truth was already in place. This was not a story of rogue employees. It was a story of a system that made misconduct feel necessary, and the customers had not even begun to notice yet. Chapter 2. Customers discover the damage. The first signs looked like mistakes. A monthly statement with an unfamiliar line. A fee labeled maintenance on an account the customer did not remember opening. Many assumed it was a misunderstanding. Banks made errors. Customer service would fix it. Some customers called and were reassured. An account was closed, a fee reversed, an apology offered. What they were not told was that the same thing might already be happening again under their name. Others were not so lucky. A credit card appeared on a credit report. A dip in a score triggered a higher interest rate. A loan application stalled. Customers asked questions and received partial answers. The accounts existed. The paperwork was in the system. From the bank's perspective, they were real. As complaints spread, patterns emerged. Accounts opened without signatures. Email addresses customers said they never owned. Personal identification numbers set without consent. Products activated without explanation. The mistakes followed the same shape, again and again. Some customers escalated. Branch managers reviewed files and blamed clerical errors. Call center representatives repeated scripts. The accounts were legitimate according to records. If there was a problem, it could be resolved individually, case by case. That framing kept the scope hidden. Customers began filing complaints with regulators. State agencies logged calls. The Consumer Financial Protection Bureau collected reports that described the same experience using different words. Unauthorized accounts, fees without consent, credit damage. The volume grew. Investigative reporters started connecting the dots. They reviewed complaint databases and interviewed former employees. What customers experienced on the outside matched what workers described on the inside. The unauthorized accounts were not random. They followed incentives. Documents surfaced showing internal awareness. Branches with unusually high account openings but low customer usage. Audit reports flagging irregular enrollment. Termination records that punished whistleblowers rather than stopping misconduct. The picture sharpened. Leadership at Wells Fargo continued to emphasize that misconduct was limited. Public statements highlighted corrective action. Thousands of employees had been disciplined or fired. Ethics training had been expanded. Controls had been strengthened. What those statements did not explain was why the behavior persisted year after year. Regulators pushed deeper. They demanded internal emails, sales reports, compliance reviews. The The material showed pressure flowing downward through every layer of the organization. Sales goals did not pause during investigations. Branches continued to be ranked. Managers continued to be evaluated by numbers. Customers learned they were not alone. Class actions formed. Advocacy groups amplified stories. People compared notes and realized the same thing had happened across states and time. Trust eroded quickly once the pattern was visible. For many, the damage went beyond fees, a missed mortgage rate, a denied loan, time spent fighting errors that should never have existed, the sense that a bank had used their identity as raw material for internal targets. Employees who had participated felt the pressure shift. The same institution that demanded results now emphasized compliance. Some workers were fired and publicly labeled as wrongdoers. Others watched and wondered why the system that forced the behavior remained intact. Investigators focused on the timeline. When did leadership know? What did they do? Internal reports showed warnings years earlier. Ethics complaints that predated public exposure. Patterns that could not be explained by isolated misconduct. The defense narrowed. The bank argued that policies prohibited the behavior. Training warned against it. The responsibility lay with individuals who broke the rules. Regulators questioned whether that explanation fit the evidence. Customers followed the news with a mix of anger and disbelief. The brand they trusted was now synonymous with manipulation. Branch visits felt different. Conversations felt guarded. People checked statements more closely. Some closed accounts altogether. As pressure mounted, regulators prepared formal actions. The investigation shifted from individual harm to systemic failure. The question was no longer whether unauthorized accounts existed. That was established. The question was how a major financial institution allowed it to continue. Behind the scenes, negotiations began, penalties were discussed, remediation plans drafted, leadership prepared for public reckoning. The story was moving out of the branches and into hearing rooms. For customers, the realization settled in slowly. This was not a mistake that happened to them alone. It was something done to millions, quietly, by design. Over years, the damage was now visible. The explanation was still incomplete, and the moment of accountability was approaching fast. Chapter 3. Exposure, Accountability, and Aftermath. The shift from rumor to record happened quickly once regulators finished piecing the evidence together. What had lived for years inside complaint logs, internal audits, and quiet settlements moved into public view. Investigations confirmed that the unauthorized accounts were not rare errors. They were widespread, repeated, and sustained. Regulatory findings showed that millions of deposit and credit accounts had been opened without customer consent over several years. The behavior cut across regions and job roles. The numbers erased any remaining claim that the misconduct was limited or accidental. It had scale, it had duration, it had structure. The public response was immediate. Headlines framed the scandal as a betrayal of everyday customers. Congressional committees scheduled hearings. Executives were called to testify under oath. Lawmakers asked simple questions that demanded difficult answers. How did this happen? Who knew? Why did it continue? Senior leaders acknowledged wrongdoing but resisted systemic blame. They emphasized that policies prohibited the behavior. They pointed to employees who had been terminated. They framed the misconduct as a failure of culture at the branch level rather than strategy at the top. Regulators did not accept that framing. Consent orders followed. Federal agencies imposed penalties totaling hundreds of millions of dollars. The fines were paired with requirements. Sales practices were restricted. Oversight was increased. Independent monitors were installed. Customer remediation programs were mandated. For the first time, the sales model itself was formally challenged. Cross-sell targets were scaled back. Incentive structures were rewritten. Branch employees were told to focus on service rather than volume. The language inside the company changed, at least on paper. Leadership changes followed. Executives resigned or retired under pressure. Public apologies were issued. Statements promised reform and accountability. The institution acknowledged failures in supervision and risk management, though often stopping short of admitting intent. Customers received notices explaining that unauthorized accounts might have been opened in their names. Refunds were issued. Credit reports were corrected. Hotlines were established. For some, the remediation came years after the harm occurred. The reputational damage was harder to repair. Trust once broken did not return on command. Surveys showed declining confidence. Longtime customers moved their money. New customers hesitated. The brand that once symbolized stability became shorthand for manipulation. Inside Wells Fargo, employees felt the shift immediately. Sales boards disappeared, daily quotas were removed, managers were instructed to stop tracking product counts. The pressure eased, but the memory remained. Some workers felt relief, others felt exposed. Thousands who had been fired during the height of the scandal were never rehired. Their termination records still reflected performance failures, not whistleblowing. The cost of resistance had already been paid. Regulators continued monitoring. Follow-up reports examined whether reforms were real or cosmetic. Additional enforcement actions followed when new compliance failures surfaced. The scrutiny did not end with the initial fines. It became ongoing. Lawmakers used the case as a warning. Hearings referenced the scandal when discussing consumer protection and bank oversight. The narrative shifted from one company to an industry lesson. Incentives matter. Pressure shapes behavior. Ethics policies fail when survival depends on breaking them. For customers, the story closed unevenly. Some received refunds and moved on. Others never fully understood what had been done in their names. Many learned to distrust automated banking systems and scrutinize statements more closely. The burden of vigilance shifted onto the public. The aftermath also reshaped how regulators approached sales-driven misconduct. Institutions across the financial sector reevaluated incentive programs, internal audits expanded, compliance departments gained authority. The fear of becoming the next headline changed behavior. Yet the core tension remained unresolved. Large organizations still relied on metrics, performance still mattered. The line between ambition and abuse was thinner than policy suggested. The scandal did not erase that risk, it exposed it. Years later, the case remained a reference point. Training programs cited it. Ethics modules referenced it. Employees were reminded of what happens when numbers override judgment. The story became institutional memory, even as the people involved moved on. The final cost was not measured only in fines or lost customers. It was measured in trust that could not be fully restored. A quiet understanding settled in among the public. Systems designed without safeguards will eventually exploit those they claim to serve. The unauthorized accounts were closed, the hearings ended, the headlines faded, but the lessons stayed sharp. When pressure is constant and accountability is distant, misconduct stops being an exception. It becomes a feature.